Well, good afternoon, everybody. I'm Brad Newman, and Emily Sippel is with me. We're both with Fort Pitt Capital, and today we're joined by Karla Mitchell from the Ronald McDonald House of Central PA for today's conversation. And we're really happy to be here to chat about charitable giving strategies, especially this month with the end of November on the 29th being Giving Tuesday, which is, I think, probably the biggest day nationwide for charitable giving. And I'll just say, you know, the importance of charitable giving has never been more important than it has been in the past several years. There's certainly been a lot of capacity for giving, but we're also seeing needs at probably near all-time highs. So today we're just going to walk through some of the strategies that are out there for charitable giving, and discuss how, in connection with your tax advisor, we can help people walk through their options for donating to charities. But before we get going, just a little bit of background. That didn't advance, Emily. I don't know if you can make that go to the next slide. There we go. A little bit of background about Fort Pitt Capital. You know, we're really happy to present this whole series of webinars. We've been doing these very regularly since COVID started. And just for, I think some of the things that really make us unique or differentiate us are, you know, number one, we do make all of our investment decisions and do all of our planning in-house. You know, we don't farm those things out to a third party, which is really becoming the trend in the industry. So when you work with us, you're really dealing with the people that are making the decisions, and you've got access. I think secondly, we really use, you know, a team approach to provide a boutique feel for all of our clients. Our clients, you know, don't want to be a number. They want to know the people that we're working with, and that's really important to us as well. And I think finally, we take a holistic approach to every relationship, and this involves customized retirement planning and working with clients on all aspects of their financial lives, not just managing their portfolio. So while our clients predominantly come to us to manage their portfolios and do financial planning work, our relationships go deeper. We're focused on things like charitable planning or Social Security planning or intergenerational giving. So as we'll touch on several times today, we really do value collaboration, not just with you, but with your advisors, attorneys and accountants. And, you know, we firmly believe that you get the best result when, you know, everybody's involved in that process with their own, you know, specific areas of expertise. So for those of you not familiar with our webinars, they are designed to be educational, and, you know, touch on the areas of interest to, you know, across their lives. So we'll take just a minute for us to introduce ourselves. I'm Brad Newman. I've been with Fort Pitt for about 19 years, been working with clients for over 25 years to really kind of help them quantify and meet all of their financial goals and needs. And I'm really glad that we're able to do this, you know, program on charitable giving. Just to give you some of my background, I currently serve on the investment committee for our local United Way. I serve on the investment committee, finance committee, and the board for Ronald McDonald House of Central Pennsylvania. And beyond that, my wife has spent her entire career with the YMCAs. I mean, she's never collected a paycheck from another organization. So I really know firsthand the importance of charitable giving, how it impacts these organizations. And, you know, with that, Emily, I'll let you share a little bit of your background.
Thanks, Brad. Hi, my name's Emily Sippel, and I'm a certified financial planning professional with Fort Pitt. I've worked in the financial industry, specifically for RIAs, for over 12 years now. I spent the first few years working out of Boston, Massachusetts, and then I moved to New York City, where I spent where I spent 7 years developing my financial knowledge and planning skills. Pittsburgh is where I was born and raised, and when it came time to move back to my hometown about 2.5 years ago, becoming part of the Fort Pitt team felt like it was the natural next step for my career. So beyond being a certified financial planner professional with Fort Pitt, I'm a planner by nature, and assisting people in planning for their future and achieving their goals is something that I find very fulfilling. Outside of work, I come from a really large family, and we enjoy spending a lot of time together, being active, doing anything from yoga to hiking to various water sports. So I'm really happy to be here with everyone today to talk about charitable gifting. Before we get started, I would like to review a few housekeeping items about how to interact here within the webinar for our viewers. So for those of you on a device, let's see here, you should see a button in the lower right-hand corner where the arrow on the screen is directing you to for further questions and handouts. You can submit questions here that you want to ask throughout our session. And we have also received several questions ahead of time. We're going to try and get to these during our question and answer session at the end of our presentation. For any of those questions that we don't get to due to time limitations, we will contact you afterwards, whether it be your current Fort Pitt advisor or one of the presenters from today's webinar, just to make sure that you get all of the information and answers that you need. For those on a laptop or a desktop computer, you should also see areas in your right-hand settings column for handouts and questions. And with all of that being said, I would like to introduce you to our guest today, Karla Mitchell, the Executive Director of the Ronald McDonald House in Central Pennsylvania.
Thanks, Emily, Brad. Happy to be on the call today. So hi, everyone. Excited to share information about Ronald McDonald House Charities, as well as our chapter, Ronald McDonald House Charities of Central Pennsylvania. Each one of our chapters are part of a much larger global system that focuses on keeping families together and obviously near the care and resources that they and their children need. I cannot also, Emily, move the slide. Here we go. Thank you.
I think that you may have.
Oh, did I? Okay. Let me try.
If you need me to jump in at any point, just let me know.
I got it. Thank you. It was probably just a delay, so I apologize. So, essentially, while I am focusing on Ronald McDonald House Charities of Central Pennsylvania, I understand that there are many of you who aren't necessarily from this area. So I'm going to try and talk about what we do at a broader perspective to be able to hopefully give you enough information and how to connect you to your local chapters if you're interested, to get a better sense or feel of what we do. And essentially, the idea is, behind our organization is to provide a place of respite for families whose children are receiving essential medical care. We're trying to keep them near each other, near their medical community, near their medical providers, and doing it in a way that decreases their stress and their financial burden, and gives them an opportunity to focus on what really matters, obviously, which is the health of their child. And there are three core programs that the system has that are very beneficial to our families. The first is obviously the Ronald McDonald House. We have 185 of them in the United States, and as you can see from this slide, there's 376 around the world, so we are a global entity. The second program is what we call family rooms. There are 147 in the United States, and we also have one of those as well, and about 260 around the world. They are think of the Ronald McDonald House, but on a smaller scale. So, and we're going to go over that information just a little bit more in detail. And then the other major program that they have is called a care mobile. You're not seeing that on this slide because we don't have one locally, but essentially it's a large mobile medical unit that provides care, mostly dental and vision care to children and families in high urban areas. Philadelphia and Pittsburgh both have a mobile care mobile. We have instead in our footprint several hospitality carts and a kiosk that provides similar services but on a smaller scale, and both of them are located on what we call in-hospital programs. And this is a picture of our beautiful Ronald McDonald House in Hershey. Every single Ronald McDonald House is different. It's very embodies the community in which it lies. And so in our area in Hershey, you know, you're going to see a lot of artwork and, you know, things that embody the Hershey community and South Central Pennsylvania. But the house is just like yours or mine, except that it's much larger, and it has multiples of things. So where you may only have 1 or 2 living rooms in your house, we have 4. You may have 1 kitchen, we have 2 very large industrial kitchens. It's 35 bedrooms, 32,000 square feet, and it is really a beautiful place for families to come and just take a break and receive services, you know, from our organization. We had last year 4,600 overnight stays at our Ronald McDonald House, even during COVID and with occupancy restrictions. Our average stay is 6 nights. And last year, our longest stay was 105 nights. The year before, it was 365. So we had a family that stayed with us for a whole entire year while their child was receiving care. On average, it would have cost our families about $150 a day. We save them about $150 a day when they stay with us. So if you think about that, and the longest stay that was last year, that saved that family about $15,000 in costs that they would have had to have incurred, including additional medical expenses. So our services are certainly very valued and very much in need for the families that we serve. So I mentioned earlier, one of the programs we have is our in-hospital family room and kiosk services. This here is a slide of our family room that's over at Penn State Children's Hospital. It's located right next to the NICU on the 7th floor of the hospital, excuse me, 8th floor of the hospital. And it's a wonderful small space for families to utilize. And they can just be steps away from their child's bedside, which is wonderful. And then we have our hospitality carts and kiosk. Our hospitality carts are at Penn State Children's Hospital as well, and the kiosk is located at Lancaster General Hospital. These provide very similar services as a family room, but obviously they're mobile and small and stationary, and families can just walk out and have access to those services. So we really try and think about going to the families to the best of our abilities and being able to provide them with the services that they need. It's mostly snacks, small activities. In the winter time, you might find things like hand lotion, lip balms, hand sanitizer in particular, more than anything, cups of coffee, things like that, that are very valued by our families. And again, while these are particular to us, most chapters have these same similar services in their community as well as with their medical partners. Some key things to remember about us: all of our services that we provide to our families through majority of the chapters are all at no charge to the families, thanks obviously to our community of supporters, which we would not be able to do it without them. And in a normal year, we serve about 1,600 individual families through our size chapter here in Central Pennsylvania. Obviously that varies by the size and how large the medical partners are that the chapter is partnering with in their communities. And for our chapter, volunteerism is huge. We have about 60 volunteers that provide significant support to our organization, but it is a huge gap right now in service delivery for all chapters across the organization. And so if you're in an area and you're thinking about getting involved and getting, volunteering, Ronald McDonald House Charities is certainly one of those organizations or nonprofits that desperately is in need of additional volunteer help. So I would encourage you to take advantage of that if you can, because there's a lot of opportunities for that. And I can obviously go on and on. I could, I'm very passionate about our organization, but somebody who can actually share a little bit more direct impact of the services that we provide, obviously, is a family. And so we wanted to introduce you to the Ginny family. And if you're having trouble hearing the video at all, just know there is closed captioning, and I would encourage you to read that as the video progresses. It's very brief.
We are from Guatemala City, Central America. Sophia has been diagnosed with Ewing sarcoma. What it brings us to the United States is for a second opinion for our daughter's disease. The flight is a direct flight from Guatemala to here is 5 hours. From our perspective as a family, the best part of being here is that we feel home since the first day that we be here. Everything is very secure, is organized, and it's clean. So that makes us like feel not being in a hotel room. It's more like being home. It was wonderful because we take breakfast. Usually when it was sunny and beautiful weather, we went outside to take some food. Also, it was a great experience for Sophie. It was the first time to see snow. So we went out to the snow and played in the garden with all the snow and everything. And that was just a wonderful experience for her. I think that the best part of being here was the full package, everything. To be close to the hospital, to have warm and hot food, and have a nice place to stay. When you are outside of the country, for us, it was so important to have a place that we have everything included. I think one of the things that help us a lot with dealing with all the distance and being apart is that we feel in the hospital and here that we are like close to family. That helps us a lot to deal with the being apart. Because of the COVID, we were at the room most of the time. So they were thinking about what we can do to make Sophie the days shorter than longer with activities and fun things to do. They provide us also with crafts and markers, doing a lot of art and things. And I think that that was wonderful because I think that Sophie and myself, we didn't feel the time. It was almost 3 months being here. The time flew by. We have a lot of gratitude with all the people here, everything that we need during this difficult and painful time that we are living.
The last thing that you want to have to worry when you have a child with a disease of this type is to worry about when the child is going to sleep, when the child is going to be safe and secure. We don't know what we would have done without the help that you have provided us.
Ronald McDonald House, we're going to miss you.
So the Ginny family is just one example of the thousands of families that we're able to serve here at our chapter. All the chapters in the United States, around the world, thousands of families are helped every year from Ronald McDonald House Charities. And you got to see through the video a little bit more about the services we provide. And it's an amazing organization when families, they need us the most. And so how can you help? How can you help with chapters in your organization, or how can you connect with ones in your community? We want to say thank you first and foremost, to anyone who might be on the call who has been engaged or, donated to the organization, because we really can't do it without you, and we're very grateful for that. And so I just want to make sure you understand our appreciation. And if you want to get involved and you haven't done so before, obviously, you can connect with any of the chapters via the internet, but you can look up our web address, which is on here as well, which is rmhc-centralpa.org. But if you're not sure on how to find a chapter, you can go directly to Ronald McDonald House Charities, which is the global entity of our organization. And if you open up their website, get to their page, there is a box at the top that says find a chapter. And you want to click on that, and that will open up and allow you to type in your zip code and find for you the closest chapters to your area so that you can connect directly with them. And much of what I've talked about today, you know, we're sister chapters. There's a lot of the same needs and a lot of the same programming in each chapter. So ways to get involved, you know, come to our events, sponsor, make donations. Obviously, financial contributions are the largest way that you can help any nonprofit out there, including ours. Check out the wish list items that chapters have, because these are the key things that we're saying to the community are the most important things that we need, versus just assuming that we need something. Check those out because it's really helpful. Follow us on social, and of course sign up for, you know, our newsletters and things like that. But these are the most critical ways that you can help our organization. So hopefully that's some good information for you all, and we'll share more as we go through the presentation.
Thanks, Karla. And you know, we really, when we think about charitable giving, we kind of think of it as an opportunity to do good and to do well by doing good. And, you know, the video is certainly a great example of the doing good. The doing well by doing good is really the point that, you know, when charitable giving is done correctly, it's a win-win. It's something, the gifting and the giving will support the organizations that are meaningful to you, support the overall community, but also provide you with some meaningful tax benefits. And as you consider your charitable giving and what we're going to talk about today, at a high level, it's really important to remember that the concepts that we're going to be discussing, these are gifting strategies that have tax benefits to them, not the other way around. There really has to be that charitable intent for any of these to work. And the other point that I'll make at a high level, we're going to, you know, probably mention this several times this afternoon, but some of these tax-related issues that we're going to talk about today, you know, understand that none of the three of us are accountants. You should always consult your accountant before implementing any strategy that we're going to be talking about. And like I said at the onset, you know, Emily and I know Karla as well, are really happy to, you know, collaborate with the accountants. It's important to have them on board. They understand your entire situation. And you know, these are decisions that can't be made in a vacuum. They've got to be made in the context of your entire set of circumstances. So with that being said, let's kind of drill down. And there's really three main areas that we're going to discuss today. There's going to be direct immediate contributions, and these are probably the most straightforward. These are ones where you make the gift today, the charity receives the benefit today, and the contribution and reception of the gift are immediate. And these are going to be things like cash and appreciated stock and qualified charitable distributions. The second group is going to be direct deferred. And these are gifts that you're going to make today, but there's going to be a lag until the charity receives the benefit. You know, the ultimate gift is somewhat deferred. So these are going to be things like donor advised funds and endowments and foundations. And finally, there's going to be structured gifts. And these are the most complex of the three. And they're going to be things that involve, you know, charitable trusts. But again, we can't stress enough as we go through this that these aren't decisions to be made in a vacuum, and they certainly aren't decisions to be made without the guidance of your accountant and in some cases attorney. But with that being said, Emily, maybe you can give us you know, an overview and some details on some of the direct and immediate gifts.
Absolutely, Brad. I am gonna fill our whole slide here before I get started. But, you know, as Brad said, direct immediate contributions are gifts made directly from an individual to a charity, which the charity is able to use right away. The most basic form is cash. This is the most basic gift that anyone can make. And it really is as simple as writing a check from your checking or savings account, or even taking cash straight from your pocket and giving it to a charity. You can enjoy a tax deduction by making a charitable cash contribution. However, this particular option is typically not the most tax efficient, specifically for those individuals who may not itemize on their tax return. The second type of direct immediate contribution is a qualified charitable distribution, often known as a QCD. This is the giving of money directly from your IRA to a charity. This is a very tax efficient option for individuals that own IRAs and are age 70 and a half or older, as it avoids having to pay tax on your required minimum distribution. The third type of direct immediate contributions are appreciated securities. This is the giving of investments with unrealized capital gains from your investment portfolio. Typically, it's the giving of stocks, but most types of investments can be gifted. And giving appreciated securities is advantageous from a tax perspective in that you can avoid paying capital gains tax on the appreciation or the growth of the security, and then also receive a tax deduction. There is no age limit or restriction on gifting the appreciated securities. So to dive a little deeper into the specifics of the QCDs, or qualified charitable distributions, are for individuals that own IRAs to make gifts directly from your IRA to a charity. As I mentioned earlier, one advantage of a QCD is that it allows individuals to meet their RMD, or required minimum distribution, without having to pay tax on that amount. I want to make note here that although the Secure Act was passed, moving the RMD age from 70 and a half to age 72 in 2020, this adjustment does not impact the age requirement for QCDs. As of now, an individual must be 70 and a half or older to make the eligible, to be eligible to make a QCD. And even though they've not, yet reached RMD age, that's okay. You've kind of got that year and a half leeway there. And then lastly, the maximum amount that you can gift as a QCD is $100,000 per person per tax year. So for those, filing jointly, that would be $200,000 per person or per couple per tax year. So we had multiple people submit requests that we touch on RMDs in relation to charitable gifts, and making gifts from your IRA can count toward your RMD in the current tax year and when given to a qualified charity. So in this case, you don't have to pay tax on that amount. You, as I said, can also make the QCDs in the 1.5 years leading up to entering RMD status. Once you enter RMD status, you can make these qualified charitable distributions over your RMD amount up to the $100,000. Both of these strategies ultimately help to bring down the market value of your IRA, which decreases your calculated RMD amount in subsequent years. We had also received some questions or just some, topic requests saying that they'd like to, contribute more to a charity and pay less in taxes. And hopefully this slide here, this diagram, can help to kind of explain the concept of appreciated securities. So this is, stocks are typically the most common of appreciated securities that people do gift, but other investments such as mutual funds or ETFs can be gifted. In our example here, we compare two options of how to gift a security and explain how gifting the appreciated position is quite advantageous over selling the security and gifting the net proceeds. So the diagram here assumes a position with a market value of $50,000. The top of the slide indicates a capital gains rate of 15%, and the small legalese font down there at the bottom of the slide states that there's an assumption of a 24% tax rate. Option 1, this green column, describes the scenario of selling your investment, realizing your capital gain in the position, and then gifting the net proceeds from the sale. So this is, after you pay your tax. Option 2 explains the benefit of gifting the full investment position directly to the charity so that the charity receives the full market value of the position. Because charities are tax-exempt entities, they can sell the position with no tax implications for realizing the gain themselves, since again, they are tax-exempt. There's no tax consequence for the charity to receive the appreciated stock. So kind of in summary, by gifting the appreciated security, you escape paying capital gains on the appreciation. The charity receives the full market value, which in our example here, the charity receives an additional $6,750 and you get the full $50,000 contribution benefit. The overall savings is substantial, and our example shows a tax savings of $8,370. The ideal positions to gift to a charity are positions with very low cost basis or missing cost basis that has not been reported. They do exist. These positions are difficult to sell with such unknown or large embedded capital gains. And by gifting them, you can avoid major capital gains tax bill in addition to achieving the goals of your charitable intent, to Brad's point from earlier. I know Karla has an example of how to utilize appreciated stock in a real life example.
Yeah, so we're fortunate enough of an entity to be able to receive stock, you know, on an annual basis from a variety of different donors. But one in particular that I thought I would highlight that I think is a little fascinating, as well as a good representation of as an example. Many of you may or may not know the founder of McDonald's was Ray Kroc, and he was the one who started the franchise perspective of McDonald's. And when Ray passed away, his widow gifted stock, appreciated stock, to many of the chapters that were already in existence. And so we have chosen to keep that stock, and we sell off we rebalance it and use the earned interest income off of that to support our investments and our organization. And so it has benefited us immensely to the organization by having this stock and being able to leverage it how we see fit. And I think that was really the purpose of the gift when it came to us. Some chapters just sold it off and were able to utilize those resources however they needed to, which supports Emily's example. And we have chosen to hold on to the core part of the contribution, and then, as I mentioned, utilize the earned interest income off of that stock. And when we rebalance, we're able to utilize those funds.
Excellent. And I'm going to talk a little bit about direct deferred contributions. And like I said before, what we mean by that is you're giving directly to the charity, you know, just like in the strategies that Emily outlined. But by deferred, we mean that the charity might not realize the benefit, or at least the full benefit, for either several years or until your death. So the long-term commitment is really, they often take the form of maybe a multi-year pledge, or more commonly known as a capital campaign. And so these typically allow for what we would consider to be more substantial gifts to be made to the charity, while making the gift a little bit more manageable for you to make. So you could pledge a $50,000 gift, but that gets spread over 5 years. So now you've got $10,000 to give every year for that 5-year period, and it just makes it a little bit more manageable. The gifts can be funded by all the things that Emily talked about: the cash, the appreciated securities, the QCDs, and the bequest is similar, but it's a situation where now the assets are going to pass at your death. As we've seen these used over the years, IRA dollars are really the most preferential to use. So that would allow you to pass dollars that would otherwise be taxable to your heirs to an organization that isn't going to pay any tax. And it's going to allow you to save your non-qualified or after-tax dollars for your heirs for individual people who are going to get a stepped up cost basis at your death when they inherit it, which basically means that if they had a position that was worth $100,000 and a cost basis of maybe, $25,000, meaning they would owe tax on that $75,000 gain, when you receive that as a death benefit, that gets stepped up to the $100,000, so you can sell that with no capital gains.
Brad, sorry, quick question for you. So if a donor had, let's say they had multiple life insurance policies, and they had one that they wanted to choose a charity for the beneficiary, that also would fall into this category, correct?
Absolutely. Yep. You can do it a few ways. You can just name the charity as the beneficiary and let them know. You can make it an irrevocable beneficiary, and that's where you want to probably loop in your accountant, possibly attorney, because there's more ramifications. There are tax consequences to it. We just had this conversation with a client and their accountant earlier this week about what's the ramification of how much money had the person put into the policy and premiums, what's the cash value, what's the death benefit. The life insurance policies can get a little tricky, so you absolutely want to have the accountant looped in. But also, you bring up a good point, Karla, where you want to have the charity looped in, partially so you can get recognition, but also partially so that charity can do some planning. They know that this is coming, and if they are thinking about some of the things that we're doing at Ronald McDonald as far as expansions and renovations, they can start to think about how they might use that. And I think you have an example?
I do have an example, but I want to make sure you were finished with this before I moved on to the next one. Great. So our example that we have is one that really falls under the category of giving during someone's lifetime. We are fortunate enough to have a couple examples of this where it's been a robust donation over an extended period of time to be leveraged really for long-term and emerging needs for the organization. So our friends Ken and Lisa have chosen to make their planned gift during their lifetime to our organization. They have been longtime supporters of the organization through volunteerism and being on our board and pet therapy and a couple other ways that they've been engaged, and really wanted to elevate their commitment to our organization and the future of our work. And so they decided to make annual gifts to our organization that are to be directly put into our endowment, so that it really supports that function, the endowment for long-term use in the organization. So rather than waiting until their passing, they've chosen to do that now while they can, and we are very, very grateful for that. It really just helps, but for us being able to use the earned interest income off of the endowment to plan for things that we really need now and long into the future. So it's a great example of Ken and Lisa's giving of something that they've chosen to do now.
Yeah. No, it's a great tool. So the third type is the structured gifts that I had mentioned early on, and that basically separates the contribution from the distribution. This is where you're going to put money into some sort of a vehicle that you don't have to have the dollars go directly to the charity at that time. These are a little bit more complicated, and I think one of the key points with this is these are irrevocable. So even though the charity may not see the dollars immediately, that contribution, you've made the gift, and that money is no longer yours. excuse me. So again, the commonality is that you receive that deduction today, but the end gift to the recipient charity gets made later. And some of the common situations we see people using this for all come back to when you have an unusually high income year and you're looking to really kind of leverage a tax deduction. So the two biggest examples would be, probably first and foremost, would be the sale of a business. You know, you sell a business, you've got this tremendous income this year, and you want to try to create maybe a pool of dollars that you can use for gifting down the road, but you also want to reduce your taxes from the business sale. Probably the second one would be an incredibly large income year. You know, the company did very, very well, or you got a very, very large bonus. And I think the things that we see people having as goals when they use these types of tools are often probably threefold. One, they're trying to, again, create a pool or a bucket of dollars that they can gift down the road throughout their lifetimes, maybe pre-fund their post-retirement gifting. Number two, they might have children who just aren't in very lucrative professions. Parents have been very, very successful, have a lot of assets. Kids aren't necessarily making a lot of money. They want to create that same pool or bucket for the next generation so that their kids can continue with the family's philanthropy. And third, you might have children who maybe they do have enough assets to do this, but maybe they're just not really charitably inclined. And it's important to the parents that the family name is continued on down the road. So you can segregate some dollars that the only option for the kids is to be, you know, philanthropic. So the areas that we can look at are going to be endowments, donor advised funds, charitable trusts, and foundations. Excuse me. And again, I can't stress enough, these are all, you know, irrevocable decisions that once the dollars go into these tools, they're no longer yours. You know, they belong to the charity. It requires an awful lot of forethought, and again, coordination with attorneys and accountants. So when we look at endowments, pretty much any 501c3 nonprofit is going to be, you know, appropriate for this. They're very common across churches, synagogues, colleges, universities, local nonprofits. Oftentimes they're funded over multiple years, but they're really designed to be an in perpetuity entity that's designed to support that organization forever. So the gifts that Mrs. Kroc made to all the Ronald McDonald houses is, you know, a great example. And I think, Karla, you've got another example on the endowment side as well, correct?
I'm just looking here. So we have, I think later on down the line, yes, there we go. We were really, really fortunate to have a wonderful family who, unfortunately, they used our services many years ago, and their daughter did not make it. And so they chose to honor her memory by creating a house that was very similar to Ronald McDonald House, but in the Lehigh Valley area. And it wasn't exactly like a Ronald McDonald House, but it was very similar. And so families could come and stay there. When the mom passed away and the father chose to retire, they ended up selling off the house. And so they chose to endow the gifts of the house, the return on selling it, back to organizations like ours, to Ronald McDonald House Charities, that really kind of created that initial place of respite for them when they were dealing with their daughter. And they also chose to support the medical community, the nurses, the Kidney Foundation, where one of the daughter's kidneys was given to another recipient. And so they chose to parlay this out, and in our case, it was put into our endowment. So it was a real estate gift that was sold, and then obviously we were able to put that into our endowment, which again, the donor was very excited about because it really created a legacy in memory of the daughter. It was really a full circle from the time they received services to, you know, where they ended up at the span of their charity. But once it was all dissolved, it came to us, and we now are able to continue on with that gift through our endowment, being able to serve families for many years to come because of that gift into our endowment. So we're very grateful. It's a really nice way to position your gift for a really long time.
Yeah. Well, let's circle back on the donor advised funds and charitable trust too. But the donor advised funds are really funds that are offered through custodians or brokerage firms like Schwab and Fidelity and Vanguard or T. Rowe Price. I think, fun fact, Fidelity might be the largest charity in the United States right now, because again, when you make that contribution to the donor advised fund, you've given away those dollars. You know, that entity is the charity. So they kind of offer a little bit of an off-the-shelf version of an endowment, and they're used as kind of a receptacle for you to create a bucket from which you can gift to, you know, any charity, any 501c3 charity that you choose, you know, going forward. They provide a tremendous amount of flexibility. At present, I'll just note that there's no deadline for making the gift out of the donor advised fund to the charity. But the donor advised fund has caused, I don't want to say some problems for the charities, but they've caused some maybe cash flow issues where, because you get that really large donation up front, and the charity doesn't get any benefit till it comes out of the donor advised fund, there's this lag that is created. So over the past, I'm going to say 5 to 10 years, even though charitable giving has remained level or possibly increased, the amount that has been going to the end user charities over that time frame has actually declined a little bit. And last summer, there was legislation proposed that didn't go anywhere. It was called the ACE bill, Accelerate Charitable Efforts, but the focus was that it was going to have a requirement that a donor advised fund contribution had to be distributed within 15 years for the donor to ultimately receive that deduction. So, like I said, that legislation didn't go anywhere, but it's probably likely we're going to see something like this in the future. But they're a really great tool. They provide a lot of flexibility. The charitable trusts, there's really two basic types of trust. There's a charitable remainder trust and a charitable lead trust, and we'll touch on both of them. This is where it's going to start to hit that level of complexity where you might want to have your attorney involved as well as your accountant. But as you go through these, let me see if we can get to the next slide. Whoops. There we go. So for the charitable remainder trust, it's important to note that you have to identify the charity at the time the trust is established. Like many of the things that we've talked about, they're best going to be funded with appreciated stock. So there's no taxable event when that stock is sold inside the trust, similar to the donor advised fund or the endowment or directly to the charity. And you get the same benefits that Emily outlined of just giving the appreciated stock directly to the charity. When you set this up, you also have to determine the amount of income that gets paid to that income beneficiary. And it's established as a percentage that income beneficiary, which can be you, your spouse, your children, they're going to get 3%, 5%, 7% paid out every year. It's important to note that there's calculations that have to be done to make sure that there's still a meaningful amount left to pass to the charity when the trust terminates. So again, important to have your accountant involved in this. But there will also be a substantial deduction based on what that end calculated amount is going to be. So theoretically, if you put $1 million into one of these, set up a 7% distribution back to yourself, you could wind up with several $100,000 in deductions, from this. So we can walk through the steps of it, where here you can see, number one, you make that contribution into the trust. Number two, you name the beneficiary, choose the distribution rate. And then number three, the trust pays out the remainder to the charities at the end of the term of the trust. And the term of the trust is typically no more than 20 years or 2 lifetimes. So essentially you and your spouse. The other trust is the charitable lead trust. This is a little bit different in the sense that you're basically making a gift to your heirs, but for a period of time, which you define, there's an annual gift made to the charity. So kind of almost the reverse of what we just talked about. Again, it's like the other, it's an irrevocable decision when you make this. And again, best to fund this with appreciated stock. So when we look at the moving parts, there you can see, number one, that low basis stock is contributed into the trust, then it's sold with, again, no tax impact. Second, you name the charity and choose the distribution schedule, and the charity receives the benefit. And then finally, the trust pays out the remainder to your beneficiaries that, again, that you designate. Karla, I think you've got some experience with this as well.
Yeah, we are fortunate enough to be the recipient of a really lovely trust, which is the Seacrest Charitable Trust. We are one of several nonprofits that receive benefits quarterly from the trust on an ongoing distribution of funds that they established by the institution. And it's a wonderful thing, because as charities, where there's always some, the ups and downs of giving and the markets and, just the economy and things like that, something like this is extremely beneficial because we know we can count on it, right? We know it's going to come. And so if you're looking for, and through, conversation with your attorney and your accountant and all of that, and it's an option for you, this is something that charities benefit from greatly because we can rely on it on a consistent basis. So it's a very valuable plan giving tool.
Yeah, that's a great point, Karla. And again, it just kind of underscores when you're going to be doing this type of giving and working with the charities, that communication is so important, so that, and for some people, it's not about the recognition, but from the charity's perspective, it really allows them to do better planning. And also it provides them with some stories and things that they can use as they work with other donors to say, oh, have you thought about this?
Yeah. And the other thing, Brad, I will add is I can't stress enough for anyone doing estate planning where charity, the charity or charities are they going to be the beneficiary or a beneficiary in the process, to notify the charities. Let them know, because most charities have what we call a letter of intent, and it is not that you are locked in depending on how you set it up, but with us you're not necessarily locked in, but it is really important that we know who actually has us listed as beneficiaries in their charitable endeavors. So I just want to encourage everyone, if you have that set up or you're planning on setting it up, make sure you're also reaching out to the charities. And if you are concerned about them putting that information out somewhere or giving you recognition that maybe you don't want, that's a simple conversation to have with the charity and say, I'm not looking for this, but I do want to let you know that these are my current plans for my, charitable estate, whatever that might look like.
And you can still promote the concept as an anonymous gift.
Absolutely.
So there still is that benefit for the charity to use that as a tool.
Yeah.
But, you know, just to kind of summarize what we talked about in those strategies, they are complex. There's a lot of moving pieces. As Karla said, this sometimes impacts your overall estate plan. So again, in addition to the accountant, you know, it's important you work with a seasoned trust and estates attorney. So let's finish up with, you know, some talk about foundations. And these are, you know, probably the most complex. They operate, you know, really in two ways. They're also, like we talked about for donor advised funds and things of that nature, they're a good tool for that second generation who maybe not be, you know, high income earners and have the ability to gift, or maybe aren't charitably inclined. But the two options are a community foundation or a private foundation. So the community foundations are really designed to be a little bit more turnkey. They're designed for, I would say, probably smaller level gifting. They provide all the administrative and record keeping functions. They usually charge a fee of somewhere between 1 and 1.5%. I know there's the Greater Harris, the Foundation for Enhancing Communities here. There's the Pittsburgh Foundation in Pittsburgh. Virtually every community is going to have one. And they also serve a nice role for some people who want to be charitable, but they don't really have a great plan figured out. You know, these organizations kind of know where the community needs are and can help you come up with a plan of what would be the most impactful way for you to give these dollars. The private foundations are really foundations that are run by the donors themselves. And these are really, really complex. You absolutely have to have attorneys and accountants to help you set them up and run them. You have complete autonomy in them, but you also have all the responsibility. You basically are going to be in charge of making sure all the legal filings, the tax filings, everything is done. Where they start to become scalable is probably about $5 million. I think there's some attorneys out there would say maybe $3 million, but really what you're balancing is, from a scalability standpoint, is what would it cost you to hire the community or public foundation versus what would it cost you to hire all the advisors you need to run this foundation. I'll also say that just because you have the scale to make this work doesn't necessarily mean it's the right decision for you. If this is really for people who want to be hands-on, if you don't want to be, you know, kind of running your own foundation, the community foundations are always going to be happy to help with the larger gifts. I think it's really a little bit more of what your interest is, how hands-on you want to be. We've seen some families really embrace this, and all the family members are, it's operating like a little corporation. It's how they get that next generation involved. But again, it's a very complex tool. So with that, Emily, let's open things up for questions. I see we're pretty much about 1 o'clock, but I'm sure we can squeeze 1 or 2 in.
Yeah, it looks like we're coming down to the wire here, but we've got a few questions that have come in. If I have $300,000 going to 3 charities on my death, am I limited for the RMD offset to my estate of the $100,000 only, or does it benefit all 3? Or do I have to do it over 3 years?
Well, if they're having the $300,000 going to the charities at their death, that doesn't impact the amount that they can do for the QCD. You can do both.
Yeah, the reference of the $100,000 is in particular for the QCD, not
correct.
The death. Yep.
Yeah. So if that was the case, they would, if they wanted to give, you know, $100,000 via a QCD while they were alive, they would have to do that in 3 consecutive years, or I guess really they could split that up with a spouse and probably get it done in 2 years.
Yeah. And I see another question here. I am interested in learning if the tax I must pay on my 401k disbursement can be given to charity instead of the government. And Brad and I had kind of touched on this prior to our call when it came in. And the tax payment cannot be given to the charity instead of the government. Any kind of disbursement from a retirement account, that is the QCD, and there is then no tax paid. Brad, I don't know if you want to sort of add to that.
No, I think you nailed it. You can't really segregate the gift and the tax. They're one. So if the example might be they want to give $20,000 out of it, and they're going to withhold, you know, $5,000 for taxes. You can't keep the 15 for you and send the 5 to the charity and give nothing to the government. You have to give the whole 20 to charity. You get out from under the 5,000 of tax. The government still doesn't get anything, but yeah, we can't parse it that finely, unfortunately.
Okay. Well,
and there's one more I saw here, and it was asking, it was a charity, it looked like, and they were doing reforestation, wanted to see if they could split their funds into different, we'll say, buckets, one for land acquisition, one for tree care. And as long as there's nothing specific to that, that area that we're not aware of, you know, something with Department of Natural Resources or what have you, charities are free to separate their dollars into whatever buckets they want. I know we do that at Ronald McDonald all the time, that there's a bucket for this, a bucket for that, a bucket for the other, so we know where we stand relative to certain goals. But like Emily said, if there's questions we see come in that we didn't get to, we'll certainly follow up with you. I just want to thank everybody, you know, for attending today. I'm glad we were able to you know, spark, you know, some good conversation on this. The one thing we didn't touch on is just be attuned to maybe some of the free money that's out there. You know, you often see charities say, oh, we've got a matching opportunity. There's probably going to be a fair amount of that around Giving Tuesday. And that's kind of like the match that you get on your 401k. If that charity says, hey, we're going to match dollar for dollar up to the first $50,000 we receive, that's a great opportunity to leverage your, you know, your charitable gift. And I think we do have a few webinars coming up. We've got one that's going to be some continuing education for accountants. I think that's on Monday. And then there's going to be one for how to plan your next chapter, partial retirement or full retirement in early December. And a little bit of information about us, and then our ever popular disclosure.